Kathryn, when do you start to see some of this supply chain shortages, even the labor shortages that's showing up in the data? When does it start to show up within a concern of the equity markets?
Yeah, we're already seeing it showing up in the data this morning. We saw manufacturing come in below my consensus expectations, and that's precisely because of these shortages, not only in microchips, but also in raw materials, not only in basic industrial products, but in human capital as well. And my suspicion, Taylor, is that it may not flow into the equity market pricing. It's something that's temporary in nature, and the Fed is right on that front. There are some inflation impulses which are temporary in nature, and these are a few of them. I think that the combination of higher wages and improvements on the health aspect with the increasing vaccinations and lower case count is going to pull people off the sidelines and enter the labor market. That shortage, both in labor and materials, I think, as I said, is temporary in nature. What is not temporary, Taylor, is the combination, as Romaine said, of this V-shaped recovery, which is truly, it's truly remarkable how the economy has ricocheted. And on top of that, we're continuing with both fiscal and monetary stimuli, which is the main driver of equity pricing. So my suspicion is that equities are going to continue to move higher. It's volatile. It's not a straight line, but I remain bullish for this year.
And you see that, though, today where you have industrials, right, materials, sort of that classic risk on tone really filtering through some of the big leaders. Are you all in on that value, that recovery trade?
So I'm recommending a barbell strategy, which means stay with the Fed play and the federal government play, which is both buying, of course, of $120 billion in assets per month, and then on the government side, spend without thinking twice about it. And I think that's where we need to be. Long equities, and I would add to that green energy stocks, which are going to receive just basically a fire hose of spending over the next few years, and add to that perhaps emerging markets, banks, and consumer discretionary, which we saw take a little bit of a dip today. And then on the more defensive side, which I think we aggressively have to mirror the inflationary risks in each portfolio. And this is something I've been talking about with my clients for more than 6 months, Taylor. The addition of tips. Tips have flown. It's more and more of a consensus trade now. But staples, healthcare, puts, gold, even cryptos, tips, alternatives, and real estate. These are industries and sectors and asset classes that outperform in an inflationary environment. As I said, some of it is short-term in nature, but certainly not all of it.